Happy Friday, another volatile week, yet that volatility yields success for mortgage rates. So let's uncover or unpack what took place this week from tariffs, ADP to the all important BLS jobs report and what that means for rates and ultimately what we should be telling our buyers and sellers right now. So we'll start with mortgage rates. This morning, we opened flat from where we were last week, 6.79 on a 30-year fix. At one point midweek, we saw rates touch 2025 lows at 6.64. But given some of the uncertainty around tariffs and what's taking place in Washington, we saw additional volatility pushing rates higher. Now, with this morning's BLS jobs report, which we'll get to here in a second, we saw rates moderate, which ultimately put them back to where they were last Friday. And again, based on the results of that jobs report today, the expectation is that we should continue to see further incremental declines on interest rates. And hey, I know you're all like me, lower rates is a good thing. So let's jump into this week and really what drove market as a whole. We'll jump to the good part first, BLS jobs report. As we know, jobs has taken centered stage next to inflation, and really the next window into what the Fed is going to do with rates for the duration of 2025 is really centered around price stabilization, inflation, but also a robust labor market. So as we see deterioration within the labor market, the concern around a economic slowdown takes center stage, which ultimately will put pressure on the Fed to act more swiftly, which in turn will yield further improvements in interest rates. So jobs report this morning, market was expecting 160,000 new job creations. Instead, we saw 151,000. So mildly weaker, but still not this runaway number like we saw throughout the duration of 2024. So drawing into question strength of the labor market. Additionally, unemployment was expected to remain at 4%, yet we saw it creep up to 4.1. So this reignited questions around, okay, well, how many more times will the Fed cut? We were already anticipating 2. Now, can we expect 3? Can we expect 4? Obviously, more to come on that information. One jobs report doesn't translate into a new narrative, but definitely sets the groundwork for things to come. Second, ADP, we got that yesterday, Thursday, which also showed additional weakening, significantly weakening, 70,000 or 77 new thousand. Wow. 77,000 new jobs created as opposed to the 140 expected. So again, further credence around deterioration within the labor market, which ultimately bode well for rates. Second, tariffs. As we know, tariffs have been the talk of the town. We've seen massive volatility within the stock market, which has been ultimately good for mortgage-backed securities and bonds as they've acted as a safe harbor for investors to pool money, which has driven demand, which has ultimately yielded, again, better rates. So here, what should we be telling our buyers and sellers in this moment? We're seeing the lowest rates of 2025. Yes, we're only 3 months in. However, these are lows that took better part of 2024 to achieve last year. And we know the end result as we saw an increase in activity. And that was edified with the release of mortgage applications. Both purchase and refinance are up week over week as well as year over year. So really the message we should be conveying to our clients now, take advantage of these lower rates. Spring buying is right around the corner. Inventory is starting to improve. Take advantage now. If you are running into situations where you need help communicating this message, my team and I are here to support. As always, let's make it a fantastic Friday and an even greater weekend. Thank you.